Hello, my name is Andrew Thake. I'm from Minds and Money, and I'd like to welcome you to our keynote panel discussion, which is our Gold Investment Outlook panel. Joining me today is Karim-Michel, CEO of LaMancha, Robert Crayfourd, Portfolio Manager of CQS, and Andrew Ballingal, Chief Investment Officer of Ballingal Investment Advisors. I'd like to sort of kick off our Gold Investment Outlook with maybe sort of turning to yourself, Andrew. Can you tell us a little bit about Ballingal Investment Advisors and what sort of macro trends you're seeing in the gold space at the moment?
Well, I won't spend too much on BIA other than say we've been around for the last 20 years and we've had a fairly consistent focus on resources in general and gold in particular. We've run a dedicated gold for the last 5-6 years. I think the last 12 months, we've seen this spectacular reversal in fortunes away from haven assets to risk assets, and particularly super high risk assets, whether in a cyclical or in a financial sense. And that's been reflected obviously in sharp rise in US long-term interest rates, albeit less so in real terms because inflation's moved up. And spectacular rises in risk assets of most sort, but most relevantly perhaps to gold, two competing areas. One is industrial commodities. We've seen copper, oil, and other industrial materials very sharply from very depressed levels around the COVID days, March 2020. Expectation the world economy is going to crash to levels which are now discounting and sustained rally. The other asset, which has obviously done incredibly well and is right at the outer tip of the speculative frenzy, I would suggest, is Bitcoin, which many see as the next replacement for gold. Given all that, I think gold's performance has been quite impressive, albeit well off the low in last summer.
Okay, thank you very much for that overview. Perhaps if I can bring in Robert Crayfourd of CQS. I don't know if you would have any sort of like observations to add to those sort of macro trends that kind of like Andrew sort of like gave. And I guess also just tell us a little bit about CQS as well.
Yeah, so I co-manage across 3 resources investment trusts. So one of those is a precious metal focused fund, which is Golden Prospect, precious metals. And then we have a general resources fund, which is CQS Natural Resources. And then we also have a uranium mining focused fund as well, Geiger Counter. But yeah, I mean, in general market, we've obviously, come off the back of a couple of very strong years, particularly across precious metals in the sector, and obviously we've taken a bit of a breather on a year to date with gold a bit flatter. If we look at a lot of those longer term drivers, which I'm sure we'll touch on in more detail through Q&A, but yeah, actually we think the outlook looks pretty positive. If you look at real demand and real flows, there's reasons to be optimistic. But yeah, without kind of realizing what we're going to discuss later, I'll probably pause there.
Sure. And as a like a follow-up question, I mean, how would you sort of explain, I guess, the fluctuations in the gold price so far this year? It's obviously been rather sort of like went down at sort of like start of the year, but in sort of like recent months, we've seen more of like an upwards trend.
Yeah, well, into the back end of last year and then start of this year, we definitely saw a big general risk-on rotation throughout the market. And that was focused on a big reopening trade, and we saw, as a result, we saw money rotating out of precious metals and into some of those more kind of growthy type sectors, whether it be more service-led type names. And then what we've seen actually as we've come into sort of more Feb, March time, inflation expectations really started to pick up, and that became a real material concern for the market. And then we saw ETF selling that we'd had previously of 5 months of the previous 6 months into that, then flip back to buying. And then, I mean, that's important because whilst ETF demand as an overall component isn't isn't huge, it has a real outweighted size impact when it flips from selling to buying because of that flip. Where if you look at, whether sort of central bank demand or jewelry demand, which is more stable relative, then actually that therefore has an outsized impact. But ultimately, yeah, I think the US 10-year tips yield is one of the things that we really focus on, and we think is a primary driver of precious metal pricing. And what we've seen as the world sort of focused on a reopening, we've seen new variants of the COVID virus, with the Indian one being sort of heavily in focus currently. And then we've also seen slightly slower reopenings in certain aspects, certainly in some emerging markets. And as a result, we haven't really seen yields recovering on a real yield basis because of that inflation increase, which we can talk to in more detail, but it's primarily led by pretty strong demand, but also a lot of supply disruptions, and that's been providing a positive backdrop for precious metals.
Sure. Bringing in Karim-Michel from LaMancha, I think obviously a lot of our listeners won't be sort of too familiar about what LaMancha does, so it'd be interesting to have like a little bit of like an overview and your involvement in sort of like gold, and then also I guess a little bit more about where you might expect to see the price of gold be by the end of 2021.
Okay, thank you, Andrew. So LaMancha is effectively for all intent and purpose, a resource vehicle which is focused at the moment solely on gold. We have a mandate to diversify a little bit into other metals, but I would say that our mandate is really into precious and gold. And our investment style has been to have large, very concentrated position in very, very few companies, and an investment cycle which is, I would say, 4 to 5 years on average. So to a certain extent, I kind of continuously keep reminding myself that my job is not to bet on gold because I'm exposed to it anyways, and to a certain extent focus on the idiosyncratic performance of our companies, ex-gold, if you like. So we know we're exposed to gold. That being said, I would concur with Andrew and Rob that the fundamentals for gold are positive. There is a question mark as to whether fundamentals still do work in this day and age, and especially given the money supply that we're seeing. And to a certain extent, what we've witnessed over the past few months is, to a certain extent, gold sort of catching back to its inflation-adjusted normal price, or what should be its inflation-adjusted price compared to other commodities. And I would say that happened probably in the early part of 2020 or Q1, Q2. And then since then, it's been really driven by marginal dollars on, risk off. One thing that's really encouraging us is that central banks have been acting as strong buyers when the prices have been dipping, and they've been providing support. Obviously, there's been some resistance around the 2000 levels, but to a certain extent, it seems that both the risk on, risk off seem to be fairly priced in at the moment, where to a certain extent, the impact of the vagaries of what's happening with COVID are tapering away, and people are kind of going back to more fundamental points such as yields and yield anticipation somehow. So to a certain extent, we do have a positive view on gold, otherwise we wouldn't be doing what we're doing. And we think that there is also supply disruptions that are actually going to be positive contributors into the price as well. Yeah. That being said, we also remain very prudent in terms of pricing in the upside on gold when looking at new investments.
And you talked about sort of like in your answer that's kind of like maybe the kind of gold fundamentals have changed and they aren't what they sort of like used to be. So what would be the sort of like new sort of like fundamentals that sort of determine the price of gold going sort of forward into the rest of 2021, 2022?
I think it's all going to be about money supply and patience. Obviously, the market to a certain extent is pricing in the infrastructure package in the US. But also pricing in strong recovery from COVID into the developed economies. And those are the things that are also kind of acting as gates or barriers to what gold could do effectively. So it's really more about sector rotations and effectively any disruption to the prevailing thesis on yields that could affect gold, I think. Beyond that, it's really, I really think that Bitcoin and other new reserve currencies has had an impact in terms of effectively creating concern that maybe in the future, on a secular basis, gold might not be what it used to be. We don't think that's a real threat medium term. Longer term, maybe. We don't think so, but there's a theory about that as well that's starting to emerge somehow.
Also, like three of you in the opening questions that I've asked have talked to obviously about the role of the US economy and US economic policy going sort of forward. I think maybe sort of turning back to Andrew at Ballingal Investment Advisors. What do you expect to be the ongoing impact of the US economy on the price of on the price of gold and like on kind of gold like going sort of forward? And like, have there been any sort of changes you're seeing as we've changed from a Trump presidency to a Biden one?
Well, I think on the negative side, the risk to gold clearly comes from a sustained, powerful recovery in the US economy, which create high returns on risk asset such as high yield and equity and even real estate, of course, to the relative detriment of the attractions of gold. And if it can do that without generating higher inflation than we're currently seeing, and the current consensus is that we've got a blip up in inflation that will subside over the next 12, 18 months. If it can do that, then real yields are likely to rise in the US on US Treasury bonds, and gold could come under pressure, potentially significant. That's, of course, the optimistic view on US growth and the US economy, and the pessimistic view on gold. A more optimistic view for gold is one scenario that the inflation proves more persistent and powerful than currently discounted. The authorities will have the stomach or the ability to deal with that effectively, and there will be a generalized loss of confidence in paper currencies generally, and the dollar in particular. And that's clearly gold in nominal terms can do extremely well. The other scenario, which is probably the least favored one amongst investors currently, is that the US economy is having a short-term sugar rush recovery on the back of enormous stimulus in the wake of COVID. But this recovery will not prove sustainable or as profitable as currently discounted. And risk assets come under real pressure, most obviously more speculative areas. And nominal rates fall along with inflation, but real rates probably aren't very much changed. And under that scenario, gold will likely resume its role as a haven asset. It may fall in absolute terms, but I'd expect it to outperform quite powerfully. That's really the two scenarios or three scenarios I see under which the US dollar and the US economy will affect gold over the next 12, 18 months.
Mm-hmm. And I guess that's bringing in Robert, in terms of like the post-COVID-19 recovery. Do you think, I mean, where is your like thinking like on that? Are we sort of like, you know, going to see sort of like a return to growth, or are we in a sort of like a long-term sort of like depression as we end up sort of paying for COVID-19?
Well, I'll loop in a bit of your last question as well, because I think there's some interesting longer-term dynamics to that. So we obviously had Trump weaponize the US dollar, and then as a result, we've seen central banks around the world, or certain central banks around the world, looking to diversify away from US dollar holdings, with most recent being Russia. It's quite clear that China will look to try and reduce that component as well. And now we've come into a Biden world, and we've got unprecedented levels of spending, and that's that's adding to a degree of concern about the ability of the US dollar to continue to operate as the world's sort of fiat reserve currency. And I think that's something that is therefore therefore supportive for gold ultimately, particularly within sort of central bank holdings, because it doesn't have any requirement to go through US dollar banks, and therefore it provides that greater reserve. But coming back to your question there about we're coming into a growth scenario, well, I think what we've seen is unprecedented levels of spending, and as a result, we've seen unprecedented levels of debt addition, and actually that just adds greater support for having gold, which is obviously an asset with no sort of default risk on the other side of it. So that becomes ever more relevant. And it's a very interesting question to how we ever try and exit this sort of modern monetary theory world of low interest rates for into perpetuity. I think it's going to be very difficult. It's going to be strained. We've seen the Fed starting to talk about potential tapering, which could cause a wobble. But even then, they're kind of pointing to kind of longer term, just trying to sort of plant a seed there before anything's enacted. But yeah, so we are seeing a recovery. We're coming out of COVID in multiple regions. We're seeing sort of vaccine rollout. We've had the G7 talking to vaccinating the world by the end of 2022. But the reality is, I think we still have a degree of unemployment issues. You look to the US, they're still way off getting back to the level that they were previous, like before COVID. And I think that's the primary focus of central banks rather than the actual growth itself, which makes this very difficult balancing act between trying to sort of suppress excess inflation. And we've seen how the Chinese are trying to deal with it, with sort of moving away from sort of free market type dynamics and trying to suppress speculative flows in China specifically.
Sure.
So yeah, long answer, but yes, I do think we're seeing a recovery. I think a degree of that is kind of money flow, but it's not clear what the world's going to look like as we come out of this, because we're going to see distressed government balance sheets. We're going to see pockets of emerging market currency risk, and I don't think it's just a clear cut, the world is great. I think it's going to be far more differentiated than that.
Okay, thank you very much for that. So let's going to move on to talking about gold investments and what gold investments our panelists are currently focusing on. Perhaps I can kick off with you, Karim-Michel, first. What sort of gold investments are you and LaMancha currently focusing on? What attracts you?
So I would say this is totally bifurcated, if you like. On the one hand, we're looking at assets that can generate yield, because we do think that investors will be focusing on those. Gold margins are fairly high, and we believe that investors are looking to assets that actually can generate returns. I mean, if you take all of what's been said today, the main issue with gold assets is really the lack of yield. So to the extent that gold companies focus on significant returns or enough returns to investors, you basically are combating the perception that it's an unyielding asset, and you get yourself a nice macro hedge with a yield. So I would say in the more mature space, those are the companies that we're focusing on. And then on the other opposite end of the spectrum, we're also focusing on new projects, especially I would say in the special sit space, where projects have had issues in the past and where we think we can help unlocking those issues. But to a certain extent, we believe that those assets need to be able to generate significant amounts of cash going forward once they've been built and so on and so forth, because we think that's going to be the new norm for gold companies to be seen not so much as going from one project to another project, but also being able to generate decent returns to shareholders.
Mm-hmm. And for yourself, Andrew, what sort of gold investments are you focusing on currently?
Well, our focus has been and continues to be on small and medium-sized companies, which we back to produce gold or other precious metals in due course. And our focus in those has and continues to be very much on the people behind them in terms of the shareholders. And LaMancha certainly featured in our list of favoured shareholders in the last few years. We like strong shareholders, we like smart shareholders, and above all, we like diligent, honest, and intelligent management. So we focus very much on the people running the company, their track records and their character and their abilities. And that tends to lead us into companies with market caps ranging from almost literally nothing up to about $1 billion, and then backing these companies with our money and time and support to turn into producing companies. And that's been a very successful strategy for us over the last 4, 5, 6 years. And quite a lot of the companies we backed pre-production are now in production. We have very strong value orientation, and obviously that is more apparent and it's paid for with risk, but we think we can manage that risk amongst the small and medium-sized companies which trade at significant and sometimes very significant discounts to any reasonably calculated NPV using a conservative gold price still. What's changed over the last year or so, I think, is 2 or 3 things. One is our confidence around the sustainable level of gold has moved up, and we were long-term bulls of gold over a very long period, but also when gold went through its long winter through 2014, 15, 16, our view was that the equilibrium price of gold was north of 1800. We didn't have to be more bullish than that to want to own a lot of gold shares at that point. Our view, and when I say that medium-term view, our view was that it would go 1800, perhaps 2000. We're more optimistic about longer-term outlook for gold now, but still like to remain conservative. We work our valuations on 1650 still, but our expectation is gold's equilibrium price has probably moved around 2000 over the medium term, with the potential for it to be meaningfully higher. But in the equity world, we are aware that there's been a significant increase in risk associated with valuations in particular, and some degree balance sheet. And our instinct is to go the other way. And there are 3 factors we're focusing on now to try and cushion the impact on our holdings of gold shares in the event of a disruption in the equities. Firstly, we are more sensitive to jurisdiction than with the past. Our view has been that gold turns up in lots of weird places, and people have done well digging that gold up, notwithstanding local challenges. The key is, can the team deal with that? But we are more jurisdiction sensitive now, and the world at the moment looks, COVID notwithstanding, from economic and certainly financial market standpoint, pretty rosy. We know that when times get tougher, the environment for foreign investors gets worse, and so we're much more jurisdiction sensitive than we have been. And our preference would be if we could have all our money in places like Canada, Australia, US or UK. That would be good, but we can't. But we are increasingly at the margin reducing exposure to difficult or more difficult jurisdictions. Secondly, we've backed explorers, we've backed developers, but our focus now is to have an increasing proportion of the portfolio in producers because of the certainty that delivers in terms of cash flows and returns to shareholders like ourselves in the shape ultimately of dividends or takeovers. And I think that's an important consideration we'll touch on perhaps later. And as I said, the third consideration is income. That yield, in our view, is one of the most attractive, reliable yield from gold shares. It's one of the more attractive forms of income one can have in the world. So we are increasingly sensitive to that in our investing.
Okay. And then just turning to yourself, Robert, what sort of gold investments are you currently focusing on?
Well, I'm probably going to echo some of the comments that have already been made. But I'm quite fortunate in that my funds are closed-ended, so that allows me a lot more flexibility around the underlying liquidity of those positions, which means we can very much focus on value. But I kind of describe our process as being value with catalysts. So there's a lot of names out there that are value where they don't have clear catalyst to that value being realised. And to both comments made there from Karim and Andrew, producers generating a strong cash flow yield are very hard for the market to ignore. So when you have that, then it's very easy. You're far more likely to realise something like an appropriate value. You can look at single asset producers or 2 asset producers, and they typically trade at a discount. And I think in there's a value opportunity. And we're currently quite heavily weighted towards producers, sort of circa 65-70%, with about 20-25% in developers, where you can definitely get an uplift in value. Typically, they trade at 0.4 times NAV, 0.5 times NAV, and can get up to the 0.7, 0.8 as they transition into being a producer. And then we have a much smaller component in explorers, just generally because there's some great explorers out there, but the market just seems to ignore them. So there's a lot of investors are very much focused just on producers, and as a result, that really restricts the potential acquirers of these shares when you are pre-production. So that's something we're cognizant of. So they have to be very much a quality asset that's being delineated. Just as a snapshot of where the market is today, we think generally underground miners are typically being undervalued. That's because the market, or particularly if you look to sell-side analysts, they just project in the underground reserves that have been drilled out, which typically, because you're drilling from underground, would be 4 to 5 years out maximum. And as a result, those valuations are often underappreciated on an NPV basis. Whilst we also think they probably stand a little bit better for technological improvements, whether it be electric equipment and also a lower environmental footprint, which probably needs less objection politically within the regions that they operate.
Okay, thank you very much for that. I think as we're just finishing the final sort of 5 to 10 minutes of the panel, there's a couple of closing questions and just a few issues I'd just like to sort of pick up on that I just want to sort of just delve in a little bit deeper. I think the first question is just that on ESG. I'm just keen to ask the panelists, and maybe just stay with yourself, Robert. Obviously, we had the World Gold Council last year release its ESG gold mining sort of principles. But how do you factor ESG into your investment decisions when it comes to gold companies?
Yeah, and I'm sure the other guys here will say exactly the same as me, but this ESG focus is just putting a name to something that we have done for many years. It's been a clear focus when we're investing in a company that they retain their license to operate in that country. And within that means operating to top environmental standards, because the moment that you don't, you lose that license to operate. You need support of local communities, or you can see blockades and those operations impacted. So again, that's something that's of clear focus, and mining companies have been very much leading the way on that, whether it's supporting local schools, supporting local employment, supporting local training. So it's something that we've been doing for a long time, and now it has an official name and a focus, but it's something that we're very encouraging on. And actually, I think the sector overall doesn't achieve enough attention for the benefits that actually come out, particularly on the social side. When you look to emerging markets where many of these mines are located, the social benefits are huge. I mean, this is transitioning people that into education. This is giving them social mobility, and there's some real benefits to there that I think are often understated.
Mm-hmm. Thank you for that. Karim, we had Peter Groskopf of Sprott on at Mines and Money last year, saying that 2021 we're seeing increase in gold M&A as there was a bottleneck due to COVID-19 and people traveling in 2020. Have you seen this happening?
Andrew, there has been more activity at the beginning of 2021. We're seeing a lot of interest in discussions on various subjects that we're working on, inquiries, but at the same time, I think people are not willing to repeat what happened, call it in 2011, 12, 2010, where the M&A frenzy led people paying cash and extremely high valuations for assets that were probably not worth it when considering the global kind of mix of challenges that each company would have to face. So yes, there's more interest in M&A. At the same time, there's kind of a valuation cap on what people are willing to do. And I think people are also being quite discriminating in terms of what does fit in their portfolio, what doesn't fit in their portfolio, what's a good combination versus what's not a good combination. So I would say there is a resurgence in appetite for M&A, but in a prudent and measured fashion, I think. Maybe coming back to Rob's comment on ESG, it's kind of interesting because we have had recently to start formalizing our ESG practice, and we are kind of seeing that we're going from something that our companies have been doing all along with a significant improvement in metrics over the past 5 years, I would say, to something where under pressure of regulation, we're having to turn it into tick boxing exercises, which to a certain extent may become a bit detrimental to actually achieving the better goals on the ESG front. When you're actually doing ESG as a way of living, because that there's no other alternative for a modern mining company, to have to spend so much energy on formalizing processes around maybe the less relevant metrics is something that I certainly find as a deterrent to really focusing on what matters. And we're trying to find the right balance between the tick boxing academic exercise and actually continuing to make improvements on the subjects that matter. I think mining companies have been doing really very strong and good jobs on the CSR front. I think the governance is vastly improving. There's still a certain degree of entrenchment in management, but I think people are now starting to understand that they can't do some of the things they used to do in the past. But then there's obviously one thing that I guess the whole industry can become better at. It's really energy consumption, water consumption, and in general resource consumptions. And within our portfolio companies, but also into some of the companies that we're looking at, we're seeing a much stronger emphasis on how do we actually produce more output at a lesser carbon footprint or water consumption footprint. So certainly the managements are becoming more and more aware and caring a lot more about it as individuals, if you like, than it could have been the practice. And I think the next, if you like, the next round of big improvements in the mining industry is going to be around the environmental components.
Mm-hmm. And for yourself, Andrew, obviously, feel free to add any comments to the ESG question and the M&A question that I just asked. But if I was to direct a particular question to you, I'm just quite keen to know your thoughts about Bitcoin. Would you kind of advise people to invest in sort of Bitcoin? Do you think that Bitcoin is taking away investments from people who would traditionally invest into gold?
I think I'll go back to two other three-letter words, ESG and M&A. On the ESG front, we parcel that very much with our assessment of management. And having been involved in mining as long as I have, you only have to go back to things like Octeddy and Bougainville and goodness knows how many other disasters, Rio's most recent in Pilbara, to know that the price of getting it wrong is extremely high. And prudent, intelligent management doesn't take risks on these fronts. There are risks that cannot be managed. There are jurisdictions which are what they are, things change. But this is something that management has constantly on its radar and is looking to manage risk in the companies we invest in. It's not so that occasionally they don't make mistakes, but it's something that any smart investor, any smart manager is going to have permanently on the radar. On M&A, I think the points that Rob and Karim made are extremely encouraging to two ways. Firstly, the industry in recent years, when I first started, better managed capital and shareholder respectful company than Rio Tinto. Management of these companies has not had a great reputation as steward of capital, but I think they're earning it back at a pretty significant rate over the last 4 or 5 years. And this discipline they're now showing will help get generalist investors back in. And the amazing thing about the performance of gold shares in particular, but some degree gold, it's still very much a marginal and scorned asset. Most generalists have very limited time for a limited place in their portfolios. As these companies show good discipline, good skills, then I think generalists will come back. And remember, the market cap of gold shares is still extremely small. And so I think that this is going to lead to a longer, perhaps more gradual bull market and re-rating in gold shares. But it will culminate, as all good bull markets do, in a feeding frenzy at the end. I hope I'm alive to see it, but we certainly aren't there yet. On Bitcoin, I mean, who knows, honestly? I thought it was a reasonable punt between 0 and 10,000. To me, it looked crazy at 60, 70, but there were people arguing it could go to 200. We have no way of assessing it as the reality. And it's so far from our value-oriented fundamental approach to investment. It just doesn't really stand in comparison. If you want to speculate, it may well be a fantastic speculative opportunity, but just recognize that's what you're doing.
Okay, thank you very much for that. I think that just we're kind of at the sort of top of the panel discussion, so I'm just going to go around each of the panelists in turn and ask if they had one key takeaway for the audience, like listening in about sort of gold, and about sort of like one kind of key takeaway that asked to remain with them for the like rest of the year. What would it be? So perhaps turning to yourself first, Rob, if there was one key takeaway you'd say for this audience about gold for 2021 or the rest of 2021, what would it be?
Well, I'd say if you look at spot gold and use spot gold, then gold companies are trading at lower multiple now than they have done for the last 4, 5, 6 years. I mean, they are not implying the current spot price. So within that, that's saying that you don't need a higher gold price for these companies to perform. And even many of the larger companies are trading, nearer 1 times NAV, where previously they traded as sort of high as 2.5 times. So this is a view of picking good companies, and actually, if we get further upside in gold, then that's further benefit rather than. I mean, effectively, they're already pricing in a lower gold price.
Okay, and Karim-Michel, what would be your kind of key takeaway? Karim-Michel, what would be your key takeaway?
So I subscribe to Rob's views that the sector on a spot basis is cheap. I think there is some takeaways in terms of generalist interest not being there or not yet being there. But as the sector consolidates, market caps grow, yields comes back as a feature of what gold companies do. I think there's a lot of hope that and that ESG, that the perception of ESG starts improving compared to other industries. To a certain extent, that will bring back bigger money flows into the sector and therefore enhance valuations. So I'm pretty positive on the sector for that reason.
And I'll leave the last word to Andrew Ballingal.
Well, I concur with everything that Rob and Karim have just said. I'm not sure how quickly mining can become a politically correct ESG activity, but the trends are favourable, albeit gradual. As for the gold being reasonably priced, I agree. As gold share being cheap relative to that very reasonably priced gold, I totally agree. The one word I would leave with the audience, and it's a word you should use very rarely in investment because it's such a wild card, is geopolitics. And I say that only because with the Biden presidency, geopolitics has become clearer. And when I say clear, I don't mean better. What we're seeing very clearly is that the confrontation of the West with China and to a lesser degree with Russia has been ongoing. It is not going to go away. It isn't a Trump blip. This is probably the single most important trend in the world right now. It will remain so for the next 3-5 years. It can either end benignly, it won't end very badly, but it won't end without a great deal of risk and volatility. And it's highly unlikely that gold at various points won't be a very strong beneficiary of those trends. So I don't like citing it as a factor in our investment because it's not predictable, other than that the volatility around it is going to remain high. And gold will benefit from that.
Okay, thank you very much for that. So that was our keynote panel discussion on gold investment, featuring Karim-Michel Nasr, CEO of LaMancha, Robert Crayfourd, Portfolio Manager of CQS, and Andrew Ballingal, Chief Investment Officer of Ballingal Investment Advisors. And I was your host, Andrew Thake from Minds and Money. Thank you very much.